guys. So today what we are going to be learning about is agricultural produce, IAS 41. So let's look at it. So agriculture could be divided into two components. You could say one is a biological asset, the other is agricultural produce. So what is biological asset? Anything that is a living plant or animal is a biological asset. So let's say you just bought a cow, a calf, a small calf. So that's a biological asset. And then after that, what is agricultural produce? Agricultural produce is harvest of entities biological asset. So anything which comes off the biological asset is a agricultural produce. So what is harvest? So harvest is the point at which you actually detach produce from the biological asset. So suppose the cow, when the cow gives us the milk, so that's the detachment of produce from the biological asset, and that's our harvest. Or what you could say is the cessation of biological assets life processes. So suppose when you're for a rice plant, so when the plant actually grows to its fullest, and then after that what we actually do is we cut the whole thing. So that's the cessation of its life process. So that's also a harvest. So biological asset is a living plants or animals, and then after that whatever comes off of it is a agricultural produce, and then the point at which this agricultural produce comes is, or after that what we say is harvest. So what is harvest then? It is a detachment of produce from the biological asset, whether it could be cow or plants or whatever it is, and then or it could be like you cut the whole thing off and then that's your harvest. So such as in rice plants, so you have to actually cut the whole thing and then after that that's your agricultural produce. So let's look at biological assets first of all. So when we actually recognize biological asset, there are three things that we need to consider. So one is that the entity must have control over the assets. That's always our definition of the assets in the conceptual framework as well, that the entity needs to have a control. And then it is probable, the second criteria is, it is probable that the economic benefits will flow into the entity. So that used to be our old definition of assets in conceptual framework 2. And then the third is the cost or fair value of the assets could be measured reliably. Without being able to measure reliably, we can't actually quantify the number. So that's our three criteria that we need to meet before recognizing anything as a biological asset. So first thing what we need to have is control. Second is probable that the economic benefits will flow into the entity. And then the third is cost or fair value can be measured reliably. So that's our recognition criteria. And then the interesting thing, the difference between the others and then this is in the recognition. So when we are initially recognizing biological asset, what we normally recognize is fair value less cost to sell. So important thing to remember. So see, remember, this is our cost price actually. So fair value is our cost price. So when we are actually paying for the biological asset, what we normally do is, suppose debit, credit. So what we actually give out is 10,000. Suppose we bought a cow for 10,000, and then that's our payment, right? And then after that, when we are actually recognizing the asset at initial recognition, what we will do is debit biological assets. So when we recognize biological asset, we only recognize fair value less cost to sell. So suppose if the cost to sell is 500, then we have to recognize 9,500. So there is an immediate loss of 500. So see, that's the difference between other standards and this standard is that what we actually have to do is in the initial recognition itself, we have to recognize it at fair value less cost to sell. So that will give a rise to gain or loss at the initial date of measurement. And then after that, so when we do this, when we actually recognize it at initially, we get a loss because of cost to sell. So see, the cost to sell is our loss, right? And then that's why we have a loss immediately. And then after that, in what case we might have gain? When a new calf is born. So that's a gain for us because we have a new biological asset without paying any money. So newborn calf. So that's how gain. So how do we treat that? Debit biological asset, credit, gain. After that, let's look at subsequent measurement. So subsequent measurement, what we have to do is basically very simple. So we have to revalue every at the reporting date, at every end of the year, and then after that, or could be wherever the reporting date is. So we can't say actually end of the year as well because what we might have it in July or Jan or whatever it is. And then after that, subsequent measurement, we have to revalue it every year end or at reporting date. So that will be fair value less cost to sell. Fair value less cost to sell. So anything, any gains or losses or any revaluations will actually be included in profit or loss. It's fair value through profit or loss. So it is not treated as per IAS 16 as per PPE. We don't have any revaluation surpluses or anything like that. So we actually have to treat it through profit or loss. Any gains or losses goes into profit or loss directly. So it's pretty easy. And then after that, what we will look at is agricultural produce. So let's look at agricultural produce and then how that is treated. And so agricultural produce, so as we've already talked, it's divided into two components, biological asset and then agricultural produce. Biological asset is the living plant or animals, and then after that, biological produce is the when it is harvested, the product that we get is our biological, agricultural produce. And then what's a harvest? It's a cessation of life process, or when we actually remove the product from the plant or animal. So that's pretty much it. And then after that, how do we recognize biological asset? Biological asset is initially recognized as fair value less cost to sell, and then subsequent measurement is at fair value. So it is always revalued at the end of the period. And then if the fair value can't be determined reliably, what we use is the replacement cost. And then after that, when you are looking at agricultural produce, so now the product has already been harvested. So at the point of harvest, what we normally do is at the date of harvest, so we measure it at fair value less cost to sell. So what's the fair value and then what's the cost to sell? So we subtract fair value with cost to sell, and then that's the initial recognition of the agricultural produce. So after this, immediately what happens is IAS 41 ceases to apply because now it is inventory. So until it's in the plant, so suppose it's a grapevine and then after that the grapes are growing in it, it's a biological asset. As soon as we pick it up, it's inventory now. So what will be the cost for that inventory that we just picked is the fair value less cost to sell, which was at the date of harvest. And then after that, so a few things will apply which is outside the scope of IAS 41 is in intangible assets. So that is outside the scope of agriculture. And then after that, bearer plants are also outside the scope of IAS 41. So it is treated as per PPE for bearer plants. So let's assume this is a grape tree and then grapes. So this whole plant is a PPE as per IAS 16. So it's calculated as per IAS 16 PPE. And then the fruits, the grapes which are over here, until it's unplucked, is our biological assets and is accounted for as per IAS 41. And then so what we normally do is when we are recognizing the biological asset, so what we normally do is at initial recognition we recognize it at fair value less cost to sell. So that will always give a rise to gain or loss because we actually paid more than we actually recognized. So there will be a gain or loss in that circumstance. So there will be initial recognition and then there will be subsequent recognition. So what's initial recognition? Initial recognition is initial recognition and then subsequent recognition. So initial recognition is fair value less cost to sell, and then after that, during when we actually recognize it, we immediately get a loss or a gain. So what is a loss? It's basically the cost to sell is our loss in normal circumstance, and then after that, when we have a gain is when we actually get a newborn calf or anything out of the cow or whatever the biological asset is, and then after that, subsequent recognition is always at reporting date on fair value less cost to sell. That will be our subsequent recognition. Any gains or losses on the revaluation will be charged to profit or loss. So fair value through profit or loss. So yeah, the biological asset will be back, and then once this grapes has been plucked, so suppose this is outside now, so these are our IAS 2 inventory. So on the date of harvest, it is measured at fair value less cost of sales. So what will be the cost for the inventory? Will be the fair value less cost to sell. So this will be inventory. As long as it's in the plant, it will be biological asset, and then the plant itself is if it's a bearer plant, it's a PPE. Okay, so that will be accounted for as per 16, and then this will be accounted for, the fruits will be accounted for as per IAS 41, and then the produce that we just plucked will be accounted for as per IAS 2. And then we have a land. So the land on which this particular tree is growing upon is also IAS 16. It's a PPE. So any revaluations will be treated as per IAS 16. So what we normally treat is as any revaluation gains or surplus will be taken to OCI. So let's look at government grants and agriculture and then how they actually go in together. Another important thing that we need to actually keep in mind is when accounting for government grants in the case of agriculture. So there are two models which we already know. It's a cost model or fair value model, whichever model we are using. There will be two different treatments of agriculture or for a biological assets or agriculture, right? So if you are using a cost model and then you receive a government grant, that will be accounted for as per IAS 20 accounting for government grant. So this will start to we have to account for in this IAS 20 accounting for government grants. And then if we are using fair value model, so IAS 41 will continue to exist, so it will be valid, and then after that, but there will be two more divisions to fair value model. So suppose if the grant is unconditional, then when it becomes receivable, then only we will recognize it in SOPL, and then after that, when it becomes receivable, we recognize it in SOPL, and then after that, if in case of conditional, only recognize when the conditions are met. So same as our government grants thing as well. So only when the conditions are met. So conditional thing, it's always when the conditions are met, and then in unconditional, when it becomes receivable, we actually charge it to SOPM. And then if it's a cost model, we actually do it as per IAS 20, accounting for government grant. And then so with agriculture, there should be some disclosures as well. So that's not always, that could be a very important information in this case, because people might want to know like what are your assets. So just writing biological assets don't give us any more information about the assets. So there could be like different groups of cows. So suppose this group is 3 years old and this particular group is 5 years old. So a description of a group of assets. So this, suppose this many are 3 years old, this many are 5 years old. That could give us an idea of what the economic benefits will flow into the entity, because we will know like the cow which is 5 years old is likely to be we know like the age of the assets even, and then what's the economic potential of it, so that the investors know like what will be the future cash flows based on this asset. And then what we need to disclose about is methods and significant assumptions when we actually determine the fair value. So when we determine the fair value of our biological asset is at the reporting date always. So we use certain methods, such as we could use level 1 inputs, or we could be using level 2 inputs, or we could be using level 3 inputs, or we could be using any other valuation techniques, cost, or we could be using income based, or we could be using something else, some market based. And then so that should be actually shown in the disclosure, so that the investors get a better picture of the financial statement. And then after that, reconciliation of carrying amount at opening and closing period. So there should be a column which actually shows the movement in the assets. So what's our opening at the beginning, and then what's our closing. So there might be some disposal, or there might be some sell-off, or whatever that is, and then there could be some adjustment, so which will bring us to the closing carrying amount at the end of the period. So all this information is very crucial for some of the investors, so that they can actually invest their money in this kind of business and then earn a return for themselves. And then as an accountant, it's our duty to always disclose the information which is relevant and which is faithful for our investors and then all other stakeholders whoever are concerned. So this is how we actually account for this kind of problems in agriculture. So we look at two problems as well, and then I think we should get a fair picture of how to account for agriculture. And if you have any other questions, please do comment down below. I'll definitely answer it for you. Until next time, bye bye.